Welcome. This is my weekly Friday update. If you watch my channel, you know I have many videos on various ways to help you get out of debt. However, I also do every Friday a show trying with data over time to show you week by week how to grow your wealth. You don't want to spin in this rat wheel, so to speak, and not increase your wealth over time. Kind of pointless. You can tell by my age that I've been through many different jobs, many different businesses, many different investments, but I always have goals and I always make sure that things are going, as they say, up and to the right. This is January of 2025, January 17th. In this Friday's update, we're going to go through the various things you can do to increase your wealth, just like the wealthy do. Generally speaking, what they do is they put their money into assets. And I say money. If you're in the United States, we're talking about the US dollar, whatever your fiat currency is. However, and you've probably seen more and more stories and articles about this, because of inflation, the dollar or any other currency loses value over time. You can see from this chart here that over time, the dollar has just lost value. It goes down in value. You can buy less and less with that money. $10 10 years ago would buy you a lot more than $10 today. And you know this. Look at this inflation chart here. I show it all the time. Obviously, we all know that 21, 22, 2023, look how high inflation was. Above 4%, up to 9%. Look at this chart. That hasn't gone away. So before that time, inflation was down here. Now inflation is still high in the 3s and 4s, and this hasn't gone away. So, unless this goes to 0 and below, this really isn't going to go away. So we all have to kind of just sit around and wait for hopefully our wages to go up. That stinks. Now, two things I wanted to point out recently before we get started, and that is, first off, layoffs. As you can see here, I just did layoffs in Google. We all know there's been a lot of them. If you've lost your job, or a family member, or maybe you're a 2-income household and you're down to 1, or whatever it may be, I'm really sorry to hear that. It's horrible. It's happening, and it might go on for quite a bit through 2025. And so what I always like to point out is I have links down below to videos to help you make sure that you have an emergency fund. I have to say, this is not financial advice. I'm not a financial advisor. I'm just showing you what I do. So first off, it's the emergency fund. Making sure you have cash when you need it in case something comes up you weren't expecting, like a job loss, air conditioner for the home, new car tires, whatever it may be. Now, over and above that, what we talk about is how to invest and diversify. However, 2025, what's it going to bring for us? This was on CNBC talking about rates if you're trying to pay off debt. And generally speaking, they come down here and they say, well, credit card rates might fall to 20%. Big deal. They're around 22, 24 right now. Mortgages might go to 6.5. Okay, well, they're around 7.5 now. High yield savings maybe around 4. Cars maybe around 7. Not a big deal. So it looks like in 2025, we might be looking at more layoffs, potentially a slow economy. And when it comes to paying off debts, things aren't dropping all that much. So if you take whatever extra money you have and you just leave it in the bank in cash, because of inflation, it's going to be worth less and less. So what can you do with it? So here's what we compare every month. So first thing I want to show you is what I showed at the beginning of the year. I started doing this back in February of 24, and I've benchmarked everything from there. So here are the results. If you look at this spreadsheet that I talked about a month ago, saying throughout the 2024. If you look at the top 3 rows, you can see that it says invest in column E, $10,000. What would you have profited? So if you had put money into savings, a 3-month CD or a 3-month treasury, these are the things we track, you would have ended up with $10,200, profit of $200. Now, if you had turned your cash into other assets, look at rows 7, 8, 9, 10, 11, 12. Those are the other things we track. We'll get into that in a second. Column E, your $10,000. Look at column F, would have been $4,194 profit. You would have ended up with $14,195. A substantial difference, 40%. So that's why when it comes to times when we have inflation, well, you know, cars go up in price, homes go up in price, assets go up in price. So if you've got assets instead of dollars, you're doing better. That's what we're showing here. So let's get into this week's numbers. First, we look at savings, 3-month CD, and a treasury. Those are the first three things that were on the chart. In other words, you just kept it in cash. You'll get somewhere between 0.42 on savings, 1.5 a 3-month CD, 4.58 in a 3-month treasury. That would be the return on your money. Well, remember, we looked at the inflation chart, and right now it says 2.9% for December. And I looked it up. I saw another site that said 3.1%. So you're barely beating inflation. And with taxes, your dollars are going to be worth less. So that's not helpful. Okay, so what do we look at after that? I look at gold, silver. These are commodities. Bitcoin, Ethereum, the Dow Jones, and the S&P 500. Why am I looking at these? And I've got a link down below because you can very easily go to Charles Schwab, T. Rowe Price, Fidelity, IBKR, wherever you might buy your stocks, and you can get what are called ETFs. So you don't have to go buy physical gold. You don't have to figure out how to buy a Bitcoin. And when it comes to the Dow Jones Industrial Average, that's 30 stocks. You can get an index which follows it. S&P 500, you can get an index which follows that. You don't have to go buy 500 stocks. You can just buy an index. It's been shown, there's many books that have been written, that most money managers can't even beat the yearly return on the S&P 500. So last year till now, well, right now, gold, 27.55. Last year, 20.50. Big difference. Silver, 31.20. Last year, 22.88. Bitcoin's at over $100,000, 105. Last year, 43,000. Ethereum, it's at 34.31. Last year, 22.99. Some of you may say, I don't like crypto. I don't understand it. I don't want anything to do with it. Fine. Don't purchase those assets. You can still look at the other ones. I have a channel. There's a link down below where I only discuss crypto. I'm a believer. I picked Bitcoin and Ethereum here because they both have ETFs. You don't have to figure out how to buy them, and you can easily buy and sell ETFs just by logging into your broker. That's why I chose those two, and they're the two top crypto by market capitalization. Okay. Dow Jones Industrial Average in February of last year, 38,654. Now it's 43,620. S&P 500, 49.58. And now it's 6,010. Now, past performance is not indicative of future performance, meaning these things could go down, and they might if we have some bad economic times. Now let's look at some indicators. So inflation, as we showed, is 2.9. Was around 3 last year. As you saw from the chart, it's about the same. Unemployment's gone up a little bit from 3.9 to 4.1. Now I say a little bit. 3.9 to 4.1 doesn't look like a big number change, but I believe, if I'm not mistaken, it's hundreds of thousands of jobs, if not millions. Now, 2-year Treasury and 10-year Treasury. There are the rates 4.274, 4.612. Not a huge difference. However, I always take a look at this chart when it comes to what they call inversion. Why do we look at the 10-year Treasury and the 2-year Treasury? Well, first of all, the 10-year Treasury mimics mortgage rates, or I should say is more directly correlated to mortgage rates than anything else. But we want to see that when you lock up your money for 10 years, you should be getting a higher interest rate than if you locked it up for 2 years. So this is an inversion chart. The 10-year, if this line is above the black line, that means the 10-year is paying more than the 2-year. That's what you want in a healthy economy. For a while there, it was inverted, meaning the short term was paying you more. That doesn't make sense. Well, what does that really matter? Probably seen me do this before, but if you go back over time, you can see when it was below the black line. There, 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 and there. What are these gray lines? These are bad economic times. Internet bubble, 2008 financial crisis, you name it. If you note, you can see that right before one of these bad financial times, it was inverted. Bad financial time inverted, bad financial time inverted right before, bad financial time inverted before, bad financial time inverted before. Okay. It doesn't mean that we could be heading for some bad financial times, but it's not a good sign. So it's uninverted now. That's good, but we always like to keep an eye on this. And again, be prepared, have your emergency fund. But I hope you could see from the chart I showed you that instead of $10,200 keeping your money in cash last year, had you spread it among these various index funds or ETFs for commodities, diversified, turned your money into assets. If you have ETFs, you can easily turn it back into cash. you would have ended up with, instead of 10,200, 10,000, 14,000. Huge difference. I do this every Friday so you can watch along with me to see how the markets are trending, so you can make better decisions for you and your family, and hopefully over time increase your wealth. There's nothing better than having your money work for you, meaning it goes up in value and you don't have to do anything other than put it into some of these funds every month. Have a great day. Hope this was helpful. Thanks for watching.